You want to be able to enjoy and have something that gets you out of bed every morning. So it's really about being able to do what I want to do, which is what gets me out of bed every morning when I want to do it.
Makes you pause and think like, hey, not just for me, but the people around me, we should be doing things and living a little more.
Investors, welcome back to the channel for another round here of Masters of the Market. Of course, this is our third series here with the average Joe, dividends. And of course, we also have Kevin Burgess back joining us for our third and final round here with the two of these dividend investors. Now, I'm extremely excited about this last series because we have a ton of questions that came in from all of you who have been watching this series. And most importantly, wrap us all up in this final series with some questions that are related to really the feeling and, the lifestyle of being the millionaires in terms of dividend investing. So a lifestyle, right after you build that $1 million portfolio, what's it feel like? Without further ado, guys, welcome back to Masters of the Market. Thank you again, as always, for joining me. And I want to just jump right in here with our first question of the day. And this question is going to go out towards the both of you, but it's an extremely important question. Best strategy on how to avoid, right, paying taxes when it comes to dividends. How do you both navigate through the tax game? And Joe, I'll just kick it right over to you to start.
Yeah, great question. Great question. And really, if you're a dividend investor, the best way to do it would be to invest in things that are qualified dividends rather than the unqualified. You get a better tax advantage that way. But as a dividend investor, it is what it is. You're going to be paying taxes on your gains, and that does scare some people away. But to me, I think it's a good problem to have. If you have a hefty tax bill, that means you probably you definitely had a lot of dividends come in. So, and that's something I'm really thinking a lot about as I'm making more and more in my dividends per year in taxable accounts, because it's eroding what I'm able to save because I have to pay, a tax bill on that. So I think in either next year or the year after, I'm going to start pulling back some of the dividends rather than reinvest them and actually hold them back for taxes. And this year, I may even sell a few positions where I'm upside down on. And that doesn't mean I may not, 6 months from now, reinvest back into them. But that's what I'm doing from a tax standpoint.
Yeah, so and Joe would, I think, agree with this, is that nothing we say here can be construed as tax advice because
Hmm.
neither of us are, well, I don't know. I know I'm not qualified to do that. Joe may be, but
No.
the I guess from my perspective, I have, how do I say this without getting, a bunch of comments, but I have really never invested with dividends, I'm sorry, with taxes as the forefront. Taxes are always the last thing. So I want to maximize my investment strategy first and then deal with the taxes later. And so as Joe mentioned, sometimes I will use a tax loss harvesting strategy at the end of the year. So as my passive income grows throughout the year, at the end of the year, I can also then sell some shares that I'm at a loss on and kind of limit that tax bill. But as Joe mentioned, taxes are a fact of life, and I guess the way I look at it is I try to minimize my taxes, but I don't make decisions based on taxes. I make decisions based on my investment strategy. So taxes are whatever they are, and then we pay them and move on.
Sure. Death by taxes, if you will.
Yeah.
I'd love to know then your take, or I guess, argument against those investors who are sharing, if you're going to be paying taxes on all the dividends that are coming in, why not just head right into growth?
Yeah, if you're just strictly a growth investor, then when you do need that income, then you have to start selling shares. And I became a dividend investor when I decided I don't want to sell any shares. I just want to live off of the dividends, and that's it. And so that doesn't mean you don't invest in growth, but as far as I just don't want to sell any shares. Retirement, that's my goal. So
Yeah, and I think it's helpful too to look at it in, a longer term perspective, because what we're talking about here is not tax avoidance, it's tax timing. So if I get dividends today from my shares, I pay tax today. If I have a growth stock, for instance, that doesn't pay a dividend and I wait 10 years and it grows and then I sell it, I pay the tax in 10 years, not today. And so, you could argue that tax rates in the future are going to be worse than they are today. And so, maybe that's a way to look at it. And that's why for me, dividend investing and the tax implications of having dividends, first of all, I use the income, so it's not as big a deal for me. But for somebody who's younger, as you move throughout your investing career, just recognize that you will be paying tax. It's just a matter of when. And so, dividend growth investing versus just growth investing, it's a matter of timing, not whether or not you pay tax.
Yeah, and I think the tax advantage really comes when you do retire and just live off of those qualified dividends. And that's when it really becomes magical. So
a key word there, qualified dividends. Are you able to dive a little bit deeper into what that even means, a qualified dividend?
I'll just keep it really simple. Anything that's not a REIT, but there's other things that do that. If you're invested like Coca-Cola, McDonald's, Procter and Gamble, those are all qualified. But anything that's like a REIT, there's other things too that are not qualified.
Yeah, from my perspective, the question is what are qualified dividends? And from a tax code perspective, what the IRS has decided to do is to tax dividends for certain companies at your capital gains tax rate. So it really makes it equal, getting dividends versus selling your stock for capital gain. And so if a company has a qualified dividend, then you're going to be taxed then all this is US tax, right? So you're going to be taxed at the capital gains rate from a US perspective. So I think, that's why some companies are qualified. And as Joe mentioned, there are others, dividend paying stocks that are not qualified. And what that means is that it is taxed as ordinary income.
Mm-hmm.
So if I have a tax bracket that's higher than my capital gains rate, then I'm going to be paying more tax on something. And there really, you can think of it in categories, right? There's REITs and business development companies who are, I think, the majority of the non-qualified dividends that are paid. So that's kind of, I guess, the theory behind it. And so I tend to stay with qualified in my after-tax accounts. And then I don't really care in my tax preferred accounts, right? So, if I'm not paying a tax on my, let's say, a Roth IRA, then having a higher return on a BDC might be a better solution than having a qualified dividend in there. So I tend to push my BDCs, my non-qualified dividends, into tax preferred accounts rather than, in my after tax.
So now here's an interesting one, and I'd love to catch your opinions on this. Throughout at least my, journey, from my early 20s till present, I'm 29 in investing, I feel like I've seen this particular question a lot. And we all know that we can invest into tax advantage accounts in a couple different ways. The most popular, right, being the IRA, the traditional versus the Roth. And there seems to be an argument that's out there amongst all investors, not just dividend investors, on which tax advantage account we should go into, the traditional or the Roth. I'd love to know both of your takes on if you've invested in the traditional and jumped into the Roth, or vice versa, or which one do you think we should just aim for right off the bat and stick with?
I think this is just what I've heard from other people is I think if you're going to retire with a higher income and you're younger, I would probably stick with the Roth. But if you're going to be maybe more frugal, live off less, I would go with like a tax deferred or don't pay your taxes up front and just go with a traditional IRA 401k. And that's what I've done. I have a very small amount in my Roth. But I've stuck to still everything is tax deferred for me. But it's not advice. It's just what I've done has worked well. So, I mean, there's arguments for both sides, but definitely if you're going to have a higher income later on, I think the Roth is really the way to go.
Yeah, I'm definitely in the Roth camp as well. And you know, if I step back and do the math, and let's say my assumption is that the tax rates will be exactly the same 30 years from now as they are today, the math works out to be no advantage either way. Because if you invest your money today in a traditional, you get the tax deduction today and you invest that tax deduction, right? Then you know, you move forward 30 years from now, there's going to be a number at the end of that. And then if you do the same thing with the Roth and don't pay tax on it today, but it's a lower amount, right? Because you had to pay the tax on it, and that grows tax free, you're going to end up in 30 years at the same point mathematically. But the question is, what are tax rates going to do, right? Between now and 30 years from now? My guess is they're not going lower. So I think the Roth makes a lot of sense for younger people and even maybe some of us older guys as well, if you're still putting money in, because I think it's just a good vehicle to use. But you know, the other thing to be careful of is if you're, as Joe mentioned, if you're looking to retire, you know, maybe early, right? Then you might want to consider also having an after-tax account, because that is the money that you can get to without being penalized from a tax perspective. So just make sure you have, you know, your Roth, your 401k that might be a Roth as well, and an after tax account also, so that you can begin to build a solid front for retirement.
And now here's a runoff here. It seems that one of the viewers out there, first of all, has shared off the bat that both of you have provided a lot of insights for him. So he'd like to thank you. But there's also this question here that he has where he's sharing that he maxed out now his Roth IRA, and it's nearing the end of 2023. He can't quite now put another $6,000 or so in to the lump sum there for 2024. Should he be investing right now with his lump sum, or waiting until the new tax year for him to throw in the 6,000?
I mean, my response is I don't know enough information about his situation, but let me make some assumptions. You know, I'm assuming that he's a younger person and that he's building his future. The other thing I would want to know is, what are his goals? What does he want to look to as a retirement date, right? Because that 6,000 that he can't invest yet in a tax deferred account might be a great $6,000 to start a after tax account. So, you know, if you need some bridge funds getting you from, you know, whatever age you want to retire to the time that you can, like 59 and a half, when you can get your money out without these penalties that I was talking about, then that bridge account might be this $6,000 might be a good seed for that bridge account. So there's a lot of info that I don't have there, but I guess I would go ahead and invest.
Yeah, was it? I maybe I don't understand the question fully, but it sounds like, is it timing? It sounds like they're wondering whether to invest. Yeah, so I would say most people, well, people will say just put it in right away, because I think the experts say the market goes up 70% of the time, so you have a 70% chance to be right by just putting in a lump sum. But of course, it's emotional too. Of course, the minute you put that in there, the market's probably going to go down. That's usually what happens. It's the law of just what happens.
Knowing any investor's luck, you put it in a lump
Mm-hmm.
sum, it comes right down.
Exactly.
It's happened to the best of us. Now, speaking of a lump sum, this is also another question that I've seen quite a bit. And I know it's definitely been asked on my channel on a couple different videos, but how do you both navigate through deciding like to invest the lump sum, or really spreading out that lump sum over the course of time and dollar cost averaging a little bit more slowly? That has been a question that's now come up specifically for YouTube, but I've definitely seen it across YouTube. So Kevin, we'll fire away with you first.
Yeah, and this I've struggled with this a lot, so it's certainly a very pertinent question for investors. And so the way I kind of look at it, and I got this phrase from some of my work days, you know, as the chairman of the investment committee for our company, and one of our advisors said that, you know, you can put it in as a lump sum, or you can spread it out over time, but the spread out over time is just delayed regret. And what he meant by that was, if I put it in lump sum and it goes up, I'm going to be ecstatic. If I put it in lump sum and it goes down, I'm going to wish that I had put it in over time, right? But if I put it in, if I DCA, dollar cost average, in, and it goes up, I'm going to have regretted not putting it all in at first. And then if it goes down, then I'm okay. So either way, it's probably you're going to regret your decision one way or the other. So I guess what I tend to do is I will put in like in 1/3. I will put a 1/3 in now, and then I will have a specific time frame or maybe some metrics that I'm looking at in the market, and then that'll trigger me to then put the other third in, and then I'll wait and then put the third in. So I don't spread it out over a long period of time. I might do, 3 months or 6 months, something like that. But I mean, I don't want that money just sitting there unless it has a purpose. So if it's there to invest, I want it to be invested, and I want to be making money for me. So
Actually, in August of 2022, I had that situation where I had a sum of money I had to deploy. I went through a divorce and I had equity in a home that I received. It was a result of that transaction. And so it was $150,000 that I didn't just want to have sit in the bank. And I didn't want to just put it all into the market at once. So what I did, my strategy was I put in $10,000 per week for 15 weeks. I actually did videos on it, and just dollar cost averaged that over the course of 15 weeks. And it took the emotion out of it. And I also tracked my dividend income, how it was going up with each deposit. So it's kind of exciting to see that. And luckily, the market was trending downward. So it looked like a smart investment at the time. So, but over time, I think 10, 20 years from now, if I would have put it in lump sum or whatever strategy, I don't think it's going to make that big of a difference. It's more emotion, I think, is what it was for doing that. So that's what I did with the lump sum.
Sure, I love that you actually use that example, because it's running into a similar question I had from an elder viewer I hear on the channel, who is sharing that he is closer to retirement than probably most of my other viewers, and sharing that he does have a lump sum of cash, just a tad over 100,000 in the bank. And now his question here is, how would the both of you go about investing that 100 grand if he's just a few years shy of retirement?
Wow, that's a great question. It would depend on probably a living situation. Do they own their home outright? Are they renting? If they're renting, do they want to own a home? There's a lot that goes into that, and if they're looking for income or what it is, or if are they going to work part-time? There's a whole slew of questions I think I would have to know the answers to. But if they just want to invest it, everything's taken care of, there's no debt, they don't want to use that for a down payment on a home or something like that, I would probably just put it into an index like an S&P. That's what I would do. Maybe dollar cost average it. That's what I would do.
Now, I'm curious with this one, just before we get to Kevin, in terms of buying a home, right? When you're nearing retirement, with, let's say, you're buying a home with that 100,000, right? Or if they are renting and they're going to continue to rent, but again, nearing retirement, I'd assume you want to go more with dividend stocks for income. Or how would you navigate it? Like, what would be the difference, I guess, there, if you're looking to buy the home or if you're renting, with how to invest that 100,000?
Yeah, it depends on their expenses and what they're trying to do. If they're trying to wipe out expenses, dividend stocks would make sense too. So I'm sorry, I kind of cut you off, Kevin. So
no, I didn't know if it was my turn yet or not. So the I guess there's some info that we don't have here, and so maybe a couple of scenarios that might be helpful is, so I don't know if this 100,000 is all that they have and it's sitting in cash and they want to invest it and they're close to retirement. So we'll talk about that as one scenario. And the other one is they have other investments, right? And they're sitting with $100,000 in cash and they're trying to decide, do I invest it? Do I pay my home off? Or, if they have credit card debt, do I pay my debts off, vehicles, that kind of thing. So let me take the first one. And I think Joe answered that one very well. If all they have is 100,000, then, I would invest it, because you definitely want that to grow over time. And start with an S&P 500 ETF. You don't need to know a lot about individual stocks that way. It is a great way to kind of get in, be diversified, not only just in the position, the sizes of the companies that you own, but also geographically and style and sector. And you just get a lot of good diversification that way. The other scenario would be that, they have 100,000 sitting on the side, but they've got other investments. And I would say at that point that I would pay off. If you're getting ready for retirement, my goal would be to be debt free going into retirement. So if you need to pay off your truck or car, if you need to pay off your house, and there's some math that needs to go on there, right? Because if you have a 2% mortgage in today's environment, it might not be the smartest thing to do to pay off that, but the cash flow, right? So if you've got a mortgage, and even if it's a 3%, let's say it's a 3% mortgage, and today I think it's like 7 to 8% is what you can get on the open market, but yet you've got $2,000 a month going out for a house payment. That it might be worthwhile to go ahead and pay that house off if you owe less than 100,000 on it, and get that cash flow rolling, because that cash flow is what's going to help you in retirement. So in retirement, you need less, I guess, value, and you need more income stream. And so that getting rid of that mortgage would be a great way to do that. So there's a lot that we don't know, but maybe those are a couple of scenarios that might hit close to what they were asking.
And another scenario is if they don't have a cash cushion, I think it depends. Some people use bonds. Some people I've heard just use stocks and cash, and just use those two things. But like if the stock market's not doing so well right now, and if you're in retirement, you don't want to sell shares, possibly you just use that cash cushion instead of selling your investments. And maybe having a good cushion, maybe 100K would be a little bit too high, but maybe half that. That's the cash I'm going to carry after my house gets complete. So
Sure.
Yeah, one other scenario for anybody who may be really risk averse, and so this will go against what we're trying to do here today, but money market rates are really good right now. So it could be a good, if they're really scared about, oh, if I put my money in the market, I'm going to lose my money, then go ahead and put it in a money market account, get your 5% return, right? And then begin to learn about the market and learn about stocks, and start the process that way. That's kind of the way I would approach it.
All great answers. Now, while we're still on the topic here of kind of this transitionary period, right, from career into retirement, there have been actually a couple of questions that came in all around this very similar topic, or question rather. But how would the both of you go about transitioning from more of a growth-oriented portfolio, perhaps when you were younger and trying to build the dividend investment portfolio, or in the other end of this script, if you are actually, again, nearing retirement and you have more growth positions and now you're looking to build more of an income portfolio for yourself? Is there a strategy that either of you have used or would recommend to transition your portfolio?
yeah, that's what I've been doing. When I started my dividend portfolio about 3 years ago, was just that, was to generate income. I thought I had enough in my IRA 401k to sustain me at 59 and a half. So I just wanted to build up my income. But yeah, and just going back to talking to the younger people, if I could go back in a time machine, like when I was doing my 401k and investing, it would be 100% in stocks. There'd be no bonds whatsoever. And then as you get older, I don't know, it depends on when you want to retire. I'm 50 years old, and my plan is to I think probably next year I want to go part-time still in the corporate world. And then maybe after a couple more years of that, just completely step back and probably just work part-time in something I want to do. And by that time, we'll have my house paid off. By then, expenses will be reduced even more. My son will be graduated from college, and that's what my plan is.
Yeah. So my plan and what actually happened were a little bit different. And I don't know if I've ever shared this before, but I mean, I have shared about the role that I had as a chairman of the investment committee at our company with a $14 billion portfolio. And I don't say that to brag. I say that to say the reason that my portfolio, as you see on my YouTube channel, is relatively young is that I unloaded all of my individual holdings and went into broad market holdings so that as a fiduciary to that fund, I wouldn't be considered trying to benefit my own position with that type of funds, right? So, you know, I couldn't move the market, but we certainly could move a small stock if we wanted to, right? So by not having anything attached to individual companies, there was no room for me to be, you know, even seen as having an issue with that. Um, so I guess for my transition, if I had done it without having that role, then I would have been looking at my budget, my expenses, as we talked about on a previous broadcast, and setting up my plan for how my income was going to address those expenses. And then gradually, over maybe a period of 3 to 5 years, begin transitioning into income producing assets, higher yielding dividends until I get to the level that I need. And then the rest of it, I continue, you know, looking forward. And that's the way that I have my portfolio today. My portfolio today has, you know, probably 70% dividend growth stocks, but I have 30%, almost 30% invested in an S&P 500 ETF. And why do I do that? I do that because my portfolio is about my retirement, it's about my income, but it's also about a legacy. So my portfolio, I don't want it to end when I end. I want my portfolio to last for ever, for my family, for as a legacy. And so, you know, why do I have, you know, some growth in my portfolio today, even though I'm retired? It's because, first of all, I don't need the income. And secondly, I want to have this portfolio out there as a legacy for my family.
Kevin, can any YouTube viewer of yours or subscriber claim themselves as a part of that legacy? Is anyone welcome to join the Burgess family at this point?
So
you're asking if I will adopt you? Is that what you're asking?
They just have to click the like button and subscribe.
Yeah.
That's all it takes.
Click the like, subscribe to Kevin's channel. You will be put into the will. No, it's look, that's I think that's a beautiful you know, remark in terms of leaving a legacy behind. And actually, it reminds me very much of this book that I'm currently reading, The Infinite Game. And, you know, across all areas of one's life, it's like, how are you looking at your life? Are you playing a finite game, which is, you know, there's kind of this fourth quarter moment, right? That the game will end. There's a time limit. There's two teams, and it's you v someone else. Or is it more of a infinite game, right? Where it's what you're talking about, leaving a legacy. So it's not about you, it's about, you know, those who are going to come after you, generations thereafter you. Which I bring that up because it almost seems like you have, you know, of course, the long-term approach, but you're, as you shared, right, you have a lot of dividend growth stocks, so the yields are going to be lower, right, in that 2% to 3% range. Now, is that approach still a viable option for someone, you know, in their 60s, 70s to aim for the lower yields? And should we all be looking at our dividend investment portfolios almost with like the infinite game approach?
Yeah, I think in my case, it's a hybrid approach. Before it was the infinite, you know, just to leave a legacy. I do want to do that as well, but I think I need to think more about today. And because I've been a very frugal person just by my nature, but when I look at just life and, you know, the age I am right now at 50, people around me are getting illnesses, and just people who are maybe just a little bit older than me are passing. And it's kind of, it makes you pause and think like, hey, and not just for me, but people around me, we should be doing things and living a little more. So I'm going to try to do that in the very near future rather than just try to save, invest all the time. It's just you gotta live a little bit for today, but you also have to plan for tomorrow. So trying to balance that.
Yeah, I agree with that 100%. And as most of you guys know, we do things that we enjoy. We've done a lot of traveling since I retired. We've actually, Ari, we were in Israel at this time
There we
last
go.
year. Yeah, 12 months ago, we were in Israel. And 6 months ago, I was in Egypt. So, there's a lot going on in that area, and we were super, super glad that we had traveled when we did. So I agree with what Joe's saying. I mean, you don't want to live your life so frugally that you don't experience things that are meaningful to you, and doing it with the people who are meaningful to you. So,
Hmm.
I think that's a great approach. And so, when we talk about setting this budget for retirement, it's not just about paying the light bill and about paying your gas for your car. It's about doing the things that are meaningful to you. Once you determine what that is and what that's going to cost you and what you're going to budget for that, then your dividend income portfolio has to be able to cover that. So that would drive a lot of decisions around what am I going to invest in? How much yield am I looking for? So there's a lot that, your budget will actually drive in your income strategy, your investment strategy.
Another question here that came in is actually in regards to drip for, of course, building upon the positions that we all already have within our different investment portfolios. Okay, so I'm going to kind of work through this one. So this user is using or viewer rather, is using Webull. They said that drip is not an option. So to reinvest the dividends is not an option on there. And now they're curious to know whether they should switch to Fidelity or Vanguard to be able to utilize drip. And most importantly, they're asking here, is drip even important to have turned on? There are a lot of dividend investors who seem not to use drip and then reinvest dividends and deploy the capital elsewhere.
Yeah, I use the two brokerages I use are M1 and Vanguard, and within Vanguard, it's all ETFs, mutual funds in there for me. But in M1, you can't automatically drip, but any dividend that's over $1, what I can do is just click on, let's say I got a dollar dividend, I can just click on the investment and then click buy and put the dollar and deploy it. So it's a manual process. I'm not sure what the process is within Webull, or if you can buy a fractional at $1 of whatever paid the dividend. I would try to do that, but I don't know since I don't have experience with Webull. But whenever I receive dividends in my dividend portfolio, I drip them right back into that investment. That's kind of my strategy right now.
Yeah, my advice would be switch. And it's not because I think that, a drip plan changes the world, but you want to have the option, you want to have the ability to do that. And if you decide to do it and you're in a program or in a platform that won't allow you to do it, then all of a sudden you're going to wish that you had. And so all of your history and all of your holdings are going to be in this platform that won't allow you to do what you want to do. So I would switch just to give that option. And then I'll share with what I do. I actually do both. I have certain stocks that I drip, and those are stocks that I believe are my core stocks. Those are the stocks that are going to be in my portfolio probably for a long, long, long time. And so every quarter, those dividends come in and they repurchase those shares. I don't even think about it. I just repurchase those. There's other stocks like my income producing stocks where I need that money for my budget. But even if I didn't, there might be stocks that I'm in for some shorter period of time. Maybe I'm holding them because they're undervalued for some reason, and I'm looking for that to turn around. That I may not go right back into, and I may decide to use those dividends to buy shares of a different company. So that I do both. I drip automatic, and then I also then reinvest my dividends, and I also use some of my dividends. So I want to have the option to do it. And so my advice would be go ahead and switch.
I love the strategy that you have with just not even paying attention to drip, whether it's on or off with the core investments there. And then with other investments, toggle with drip, turn it off, when necessary, perhaps have it on. What happens when the market, I mean, right now is a perfect time to have drip on. I feel like every stock you just go ahead and drip into. What happens in like a bull market scenario? Should we have turn drip off, or is there a strategy that we should use to know when to turn drip off and reallocate capital, or should we just not worry about it?
This is just personally me. I don't worry about it because usually those stocks that do big runs like that don't pay a high dividend. Like an Apple, Microsoft, Nvidia, they'll make some big jumps, but they're paying a small dividend anyway. Costco is another example. So I just drip it back in, just so I'm slowly building that position. That's my take.
Yeah, I do the same thing, maybe for a little different reason. I know I can't time the market very well. I've proven that to myself over and over again. So, I have, even in a bull market, I will allow my core stocks to just reinvest, dividend reinvest, and not try to time that. And the stocks that I don't automatically drip, I'm not trying to time that either. What I'm trying to do there is decide, do I want to invest in that company or a different company, right? So it gives me control over what to do with those dividends, not necessarily trying to time the market with.
I want to talk a little bit about FIRE. Of course, financial independence, retire early. Now, if there's a vast amount of investors who are out there across YouTube who are nearing retirement, and on the other hand, a lot of younger dividend investors are looking to retire early. And I'd be curious to get both your takes for those of us who are really on the path focused on FIRE and financial independence, retire early, living a very, very frugal life. And can you guys share from your standpoint, because I know we already touched upon it a little bit, right, about how valuable experiences are. Life is short.
I think it's a good idea, at least pursuing the FI part, the financial independence. I discovered Mr. Money Mustache, I think back in 2017-ish. I read one of his articles. I think it was the simple math behind early retirement, something like that. It blew my mind when I calculated, or just your retiring early is based upon your savings rate, really. And to me, I think it's important to pursue financial independence, but it should be for the right reasons too. And I've done this, I've been guilty of this too, where I've wanted to save and invest and to get away from a job. But I think probably the better answer is to maybe work at a job that you don't have to necessarily tolerate, but something you can do for a while and just accumulate cash. I think it's not worth it to be miserable in a job, working for decades to retire early and then hit that finish line. I don't think you're going to find happiness. I think you should try to find happiness in the now and invest and save along the way. So, because I don't think achieving financial independence or retiring early is going to make you happy. I think you need to do that in your current situation. And if you can't do that in your current situation, change it. Change jobs, do whatever you have to do. But that's my advice. I'm definitely going to retire early, whether that's in 2-3 years around there. But the thing is, though, I'm probably still going to work part-time. I'll still have the channel, which really doesn't produce revenue for me, but I'll be doing something part-time. Who knows? And just something I want to do, or in something I feel is worthwhile.
Yeah, so from my perspective, I think it's a great goal. And Joe mentioned about the budget and living frugally. But the point is that we want to we only get a finite number of years and we don't know how many of those are, right? So we want to try to do what we want to do when we want to do it. And so I consider that, I don't think of myself in a FIRE model. What I consider my model is a model of personal freedom. And so, when I think about, when you retire, you don't want to do nothing, because that's going to be extremely boring. I mean, you want to be able to enjoy and have something that gets you out of bed every morning. So it's really about being able to do what I want to do, which is what gets me out of bed every morning when I want to do it. So if I want to travel, then I should be able to travel when and there's scheduling conflicts and stuff, but you know what I mean? It's not, I can't travel because I'm committed to this 8 to 5 job that I can't get vacation from. That's different from saying, oh, we're on this trip, so we can't take this other trip at this point, right? So that, scheduling is fine, but I like to think of this as personal freedom, because you want to do something. You want to continue to grow. You want to continue to learn in retirement, and you want to do the things that are going to make you better and the people around you better. And there's got to be a way to monetize that, right? So those are just things that I would say that I think the fire movement is good in that it kind of helps you focus on living a frugal life so that you can get where you want to be. But I wouldn't set it up that I want to live that frugal life forever. And I think that's the downfall of that, that intense fire method, because you really want to have these experiences and you want to enjoy the life that you have while you have it.
Sure. I'd be curious to know, when you were both, younger, just starting out, what was the vision that you had for yourselves when you were to near retirement, or when you were to enter retirement? What did it look like? And then fast forward into present day, what does it really look like? I guess like the reality, right?
Yeah, I'll go back to when I started my career back in 1996. And, when I set up a 401k, that was my first thought of retirement. To me, I was really doing something I was told to do, or maybe something I thought I had to do. Something down the road I couldn't even envision. I'm in my early 20s, and trying to think about retirement was so far off. It was not even, it was just an afterthought. And I had misconceptions too of what retirement was going to look like. And to me, when you're investing, here's a misconception I believed in, was when you're investing, when you're younger, when you retire and you pull the trigger, you just cash out and you have a big lump sum of money, then you spend it. But actually, as you learn more, you realize you're going to be invested until you should be invested until the day you pass. And but I think most people when they're younger, it's just retirement is so far off that it's really an afterthought, and some people don't do anything. I think the best thing to do is just start investing as soon as you start your career, or you have access to a 401k, or if you're an entrepreneur, start an IRA or a self-directed 401k, whatever you can do, and just keep doing it, and you'll thank yourself later. And as I'm nearing or retirement is much closer to me now. It's different. I thought when I was going to retire, I was just gonna just be on the beach and just retire and do nothing. But I think all of us can agree, Ari, Kevin, that we're just, and people like us who kind of build a portfolio, we're not going to sit around. We're going to do something in our retirement. We're not going to sit on the beach. We're going to just pursue a different endeavor, maybe something that's less stressful, maybe takes less time, maybe just do it part-time. So that's my take on that.
Yeah, there's a lot of thoughts that run through my mind with this question, because back when I was kind of starting all of this, right, back when I was younger, and I was listening to a guy. His name is Larry Burkett. He's a financial management guy. He's been gone a long time now, but one of the questions he asked, and it really hit home with me, is he asked the question, how much is enough? And so some people would answer that with just a little bit more, right? So, you don't want to go through life saying I never have enough. I'm always building my portfolio, because then you'll never take the time to stop, right? And enjoy life, and do what you want to do, have personal freedom. So I think of that experience, and then I also think of another one. And I worked for a particular company, and the CEO came one day to our facility, and one of the things he said was, he said, "Take a day to dream." And I thought about that, and I thought that from a CEO, I would have expected him to say, give me more output, right? I want you to do this faster. I want you to do more of this, whatever that is. But he said, no, no, just take a day to dream. What do you want this job to be? What do you want this plant to produce? And how, just take a day to dream. And so I took that and applied it to my own life. And I said, what do I want this to look like in the future? And I will tell you that it looks nothing like what I had dreamed of 25 years ago. But I think as you grow and you're going to find that you have interests that you didn't know you had, right? So, so you take a day to dream about what you want your retirement to look like, but also realize that you're going to be different 25 years from now. You're going to enjoy things that you don't even know exist today. So those are kind of the things that I think of. So for instance, Ari, you mentioned the farm, and we have bought a farm, and I'm raising chickens and bees, and we had grapevines this year. So I'm actually making my very first batch of wine. And so we'll see how that turns out. But you know what I'm saying. I mean, I'm continually growing and learning and doing something that we really had not envisioned 25 years ago. It was something that my wife wanted to do 25 years ago, but we never thought it would happen. And so we said, you know what, let's do that. It's time. So we're enjoying that. So I would just say take a day to dream, set a vision for what you want your retirement to look like, develop a plan, and get after it. It might not be exactly what you think, but without doing that, you're never going to get there. So that would be my suggestion.
Fantastic. Now I read Shoe Dog by Phil Knight. This just came to mind, but both of what you just shared, this kind of planning for retirement and that happiness that you'll meet, hopefully all of us will meet in retirement, easily comes, I feel, when you're financially secure and you don't have to worry. Now, there was a chapter in Shoe Dog in which Phil Knight, for anyone who doesn't know, is the founder of Nike, but he writes about this moment when he becomes the overnight millionaire, if you will. And I got a glimpse of what it may feel like, right, to hit a moment like that, which would be this nothingness, right? Because at the end of the day, is your heart filled? Are you fulfilled? And I'm curious to know, because both of you have $1 million portfolios, or at least net worths over $1 million. And I'm curious to know, well, yes, I'm sure there is a sense of, right, you have that financial security and you feel that you're a little bit more stable, I guess, heading into retirement. What is the feeling when your accounts hit over $1 million?
Yeah, it was kind of, for me, it was just, it was an achievement, but it was really just numbers on a screen, to tell you the truth. It wasn't, because you really can't, once you achieve a millionaire status, it didn't change anything for me. There wasn't anything I changed in my life. Okay, I hit the $1 million. Now I can buy this car. All right, we're going to upgrade the house. It was just, I just carried on. It was life is normal. Okay, when am I going to get the second million? And that's really all it was for me. But as you mentioned before, it is a feeling of financial security. But I think it's more, since most of my money at that time was wrapped up in tax deferred accounts, I really couldn't touch it. But I think it's better to have like a larger, it felt better to have a larger sum of money, like over $100,000 in taxable or cash or something like that. That felt a lot better to me than what was in my IRA 401k, because it felt more real. Not that I was going to go out and spend it, but if I needed it, if there's a job loss or anything else that happened in my life, it felt a lot better to have that liquid money. And I think today a lot of people, most people in this country, have their wealth wrapped up in their home and their retirement savings. And I think a little bit more should be dedicated to a larger emergency fund and a taxable brokerage account, because you just don't know what can happen, what event can happen to you. Luckily, I haven't had those events and had to draw from it, but just having that in my back pocket has just allowed me to sleep a lot easier at night.
Yeah, so the day I passed, so let me back up for a second. Remember that day to dream? I took that day to dream and built a vision for the future, and then developed a plan, and then determined the metrics, right? That I wanted to measure in our personal lives as the CEO or CIO, Chief Investment Officer for my family. What goals did I have? And two of those were a portfolio value and a net worth, and they're different to me. So, when my net worth hit $1 million, it was a day of celebration, but it was not over, right? So, my net worth continued to increase. When my portfolio value hit $1 million, though, that was a bigger day for me. That was like hey, I can really see myself retiring at 55. So my original plan was to retire at 65 and to have an overall portfolio, stocks, real estate, and all that kind of stuff of about 3 million. I retired at 55 with about 4 million. So it worked out. Actually, we overshot that goal a little bit. But when I think about that day, it was a surreal day, but it's also, hey, this work is not done because I haven't reached my goal. My goal is to have personal freedom. And in 2009, I switched my goal from 65 to 55. That's been 14 years ago. And I will say this, and for those of you who are nearing retirement and you're getting to that place where you're about to make that leap, it is a scary jump. I'm sitting there and I've got all of this comfort in a paycheck that comes in every 2 weeks or twice a month, however often it was. And so I've got a lot of comfort in that. And so when I'm looking at my retirement income coming from my investments and passive income, then it's a hard leap because I'm physically earning this money, and now all of a sudden it's going to be passive. And is how much do I have enough? It's am I thinking of everything? I mean, it's a scary leap. I think of it kind of like jumping out of an airplane with a parachute on your back. I've never done that, but from what I hear, it's scary when you jump. But then once you jump, there's a peace that comes over you, and you realize that your parachute's going to carry the day, and you're gonna enjoy the ride down. And so that's kind of what happened to me. I looked at it 100 different ways, and I talked to a lot of different people. And at 55, I said, you know what? I've got enough. I got more than I need. So I made the jump, and now it's been peaceful. Really, the last wow, it's been 2.5 years now. I retired in 2021, so 2.5 years.
I'd love to ask you, how do you know when it is enough?
Yeah, for me, it was mathematical, right? It was I set up my budget of what I thought I would need, line by line, a detailed budget, right? I needed to pay my mortgage, which I didn't have a mortgage, but I need, maybe a taxes, and I needed to pay my electric bill. And I mean, it was very detailed. How much do I spend in groceries? What about travel? How much am I going to spend in travel? So I had this very detailed budget. And so when I had the passive income that would more than cover that, then I knew I had enough. It was not about how much I had. It was about what would that produce to get me to be able to live the life that I wanted to live. So that's the approach that I took.
Do you have something similar?
Yeah, I'm still working that out because right now I don't know when I'm building a home, like I said before, and I don't know how quickly I'm going to pay that off. It depends. I would maybe have to sell some investments, not on my dividend portfolio, but something maybe from Vanguard to pay it off early. So I'm contemplating whether or how I'm going to do it. And then that if I don't pay off the house early, I'm still working things out and timing what makes more sense to pay the house off early or just keep my investments and work part-time. I know if I just work part-time, I could probably pull the plug right now. I'd be fine. I would just be paying my expenses. But if I ride it out a year or two more, full-time in the corporate world, I know I would be able to travel and do things a lot more if I do that just for a little bit more. But I hope I don't have just the one more year syndrome I've heard about. And and I'll have like Kevin was explaining with the parachute. Hopefully, I'll have the courage to jump out of the plane a little sooner than later. So
now, Joe, you had gotten into real estate previously, but then you sold the property because it wasn't necessarily, I believe, as you shared, your game for you. And Kevin, you still own rental properties. Is that's correct? I'd love to know. So when it comes to the stock market, investing and dividend investing, we're building that legacy, but it almost seems like there is an attempt on Joe's end, right, to accelerate the income, or at least gain another income stream with real estate. Figured out, it wasn't quite for him. And then Kevin's side, you have the rental properties. I don't know how many you have, but I'd be curious to know, is jumping into owning rental properties an accelerator? Was it a good choice for you, and how has it helped you in terms of passive income and retiring? Because I think even so, Kevin, your net worth, a fair amount of it at least, is built off of that real estate, correct?
Yeah. So first of all, it is not for the faint of heart, right? So there's going to be times where you've invested in a property and you rent it out to somebody and they haven't taken care of it, and you got to deal with that. You got to evict them. You got, there's just a lot that goes with that. But I will say that we were able to kind of accelerate our plan a lot because of real estate. So at one point we had 4 rental properties, and we bought those, and they basically almost doubled in value over, let's say, a 10-year period of time. So we were able to then sell those 4 properties and do what's called a 1031 exchange, where it's a tax-free exchange or tax-deferred exchange, and invest those 4 properties into a larger beachfront property. And so the beauty of that is that I now have a rental agency who handles the renters, it handles maintenance. I have to pay for that. But if the water, if the sink faucet is leaking, they send somebody to do it. I don't deal with it. They don't even call me about it. They just do it, right? And so I get the bill for it at the end of the month. And so there's not, I don't have issues with renters. I don't have issues with maintenance. And so it's really a pretty easy thing for us at this point. Now we do get involved in improving the property and doing things that are going to help it last. It's not just about sucking all the cash out of it and letting it deteriorate. We're always improving things and making things better, and that's really on us. But that's kind of the stuff we enjoy doing. And so it works out from a personal freedom perspective. I get to do what we enjoy and then not do the things that don't cause us don't give us value, right?
Sure. And Joe, I know you sold out of your rental property, but now you're about to buy the house. You buying or building rather? You're building outright. What's the kind of game plan? Because also real estate does factor in there. Again, now before you retire.
So yeah, I'm just building a small 3-bed, 2-bath home, and I plan on living in it probably, we'll say 5 years or so. But after that, who knows? It may become a rental in 5-10 years, and I travel. Don't know. So I'm just keeping my possibilities open. But
Sure.
I just at first, when I went through my divorce, I just decided I'm just going to rent and be good with that. But I kind of miss not necessarily home ownership, but just like gardening and doing things, in the backyard, and being able to do what I want. And I think as a renter, I couldn't do as much, like tear up the yard and plant things I want to do. So, and then I also could fix my housing costs. So that's why I kind of had a change of heart with home ownership. So, but rentals, I don't know. I don't think it's not for me to have like multiple rentals, and I got a taste of it, but maybe in the future, if I do rent this house I'm building, it'll be definitely managed by somebody else. So
Yeah, one thing to keep in mind one
Go
thing to
ahead.
keep in mind too, from a real estate perspective, is if you look back, and of course, there's no guarantee of what happens in the future, but if you look back, 20 years ago, and you look at the wages, right? Let's say median wages 20 years ago versus real estate prices 20 years ago. I saw the numbers, and I'm not going to quote them because I will get them wrong, but median wages have grown some, but real estate values have doubled, tripled, quadrupled. And so a good way to build wealth is real estate, but I would not put all of my eggs in that basket. I think, dividend growth investing is a great way to build passive income as well as real estate. And then you get the best of both worlds from my perspective. And that's
Right.
what
And
we've done.
yep. And I'm trying to kind of freeze my housing costs with this house. So as
Yeah.
much as I can, because the property taxes, I can't control that. But
Interesting. No, it's it definitely as an accelerator, something I often think about heading back to the States and looking into real estate as well. It's incredibly expensive where I am. Going back stateside and double dipping into real estate on top of the dividend investment portfolio. Before we close out for our last question of this particular series with both of you, I did have a pretty targeted question that came in for Kevin. And this viewer wanted to understand why not JEPI, and what will it take for you to get into JEPI?
Yeah, that's a great question because JEPI, I think is what most people call it, is it's a covered call strategy. I think they also sell some puts and things, but it's a leveraged strategy. And it hasn't been around really long, right? I think it's been around 3 or 4 years maybe. But when I look at the total return over the last 3 years for JEPI, it's not that great. It's around 8%. Last year's maybe a 5%. So you're getting this income, but by definition, the covered call strategy limits your upside. It'll give you current income, but it limits your upside. And so, I'm not against JEPI. I think, people who have that in their portfolio, it's fine. It's a great way to get some current income. I don't personally like the strategy. And I did do some covered calls in my portfolio, and I think that's the way I would do it. If I were going to do it, I wouldn't necessarily buy JEPI. I would do my own covered call strategy. But it just doesn't work for me because, again, my goal is not current income. My goal is a legacy. And so if I need the income and things, don't go well, then and I look to push the boundaries of the income that I'm looking for from my portfolio, then I may consider that strategy. But for right now, I think I'm good without having JEPI in the portfolio. What will it take to get me there? It would take not being able to cover my bills, basically, and needing to get my yield percent up. That's what it would take.
Sure. Joe, I'd love to know from your perspective, fan of covered calls, invested in JEPI or JEPQ or any of the alike?
close. Yeah, I am a fan of it, but not for the majority of my portfolio. I invest in BST, which is more on the technology side. So it's diversified as far as what's in the portfolio. But I think, like Kevin said, though, your upside is limited. Like if in BST, it's high growth stocks. If you just invested in those alone, I think in the long run, you will make more just by investing in those companies outright rather than the covered call strategy. But I'm just doing it for just income and also raise the dividend just output of the portfolio pretty much. And I reinvest those dividends back into it and buy more shares of BST. And also, but take a look at the on the JEPI, JEPQ, especially BST. The one drawback is they do have high fees compared to like an index fund. So that's one thing to consider. And if you're young, if you're 20 years old, don't invest in JEPI or JEPQ or BST. Just invest in in the stocks. themselves, because you're limiting your upside big time. I think it's for older people to like me and Kevin, or if you don't want to invest in it, Kevin, I know you're not a fan of it, but maybe older people, I think, should consider it older than younger. If you're in your 20s, 30s, you should even look at it. That's my opinion.
Wow,
Yeah, I
I'm
totally
curious to
agree
see
with
the
that.
comments that come in.
Mhm.
If they
Yeah,
if they come
Yeah,
in
me
with that
too.
one.
yeah,
If they haven't come in already, they're coming in for that JEPI
good.
comment.
Yeah.
Oh man. For our last question here, and seriously, thank you both of you for coming on Masters of the Market, for spending countless hours answering questions, providing a lot of insights for all of us younger dividend investors, even elder dividend investors nearing retirement or anywhere in between. The last question I want to ask both of you here is, what is next? You know, and again, Kevin, I know you got the farm, and Joe, I know you're building the house, but what is it, you know, in your, you know, I guess near-term future here for yourselves when it comes to business, or when it comes to, you know, using a little bit more strategy throughout your lives? Because I think retirement really is really going to just allow you both to have free time to do something else. So I'm curious to know what's next, and what can we expect, you know, coming up in the next couple of years for both of you.
You want to go
You
first,
want to go, or
Kevin?
you
Want me
want
to
me
go?
to? Yeah, it doesn't
Uh,
matter. I'll go first. So yeah, I've always got something in the pot that's cooking, right? Some stew that I'm cooking up. But I would say that just to give you some insight into what I'm doing currently that I'm using for the future. One is I'm about to finish. I'm about 7 weeks away from finishing my second master's degree. So this
wow.
particular master's degree is in biblical studies. So my first master's degree was in business administration. This was in biblical studies. And so I want to be able to invest my life in people and create some value to them and have their lives be better because they somehow came across my path. And so yeah, that's a big driver for me. So I that's a desire, but also I have a desire to educate. I love to teach. I love to share things that I've learned, even if it's mistakes, right? Hey, don't do this because, right? I love to teach, I love to educate, and I love to make an impact on people. So I think, most will notice that I've taken a little bit of a sabbatical from my YouTube channel, and the reason is that it's been extremely busy. I've been remodeling a rental house, right? And so we're about to be done with that. But really what I've been doing is trying to think through strategically, what do I want this channel to be about? What do I offer that would be different, would be helpful, right? And then how often should I do that? So I'm putting together a strategy to where I can deliver what I believe is foundational for me, and then also something that I can do consistently and that it would be helpful and valuable to others. So look for that to begin. Actually, when I get back from the beach this week, I will begin that process. So hopefully you'll see some videos from me very soon.
Incredible.
Okay.
Joe.
Yeah. So my plans, like I said before, are I'm going to, slowly unwind my corporate career, go part-time, and that will, of course, give me more time to play these. You can see these in the background. This is taken from a stage that I was on, and I was in a band. My previous band, we played a lot of shows where we do like 3-4 hour sets. So it's kind of hard to balance that with a career and everything, and play shows, practice, and things like that. So I can dedicate a little more time to this. And I also was a competitive cyclist, and I try to train 3 times a week. Maybe I can step it up a little bit more and get back into it, and race, since I'll be a 50 plus master racer. And so do a little of that. Also, with the YouTube channel, I'll have some more time, hopefully, to improve just on my channel, because really what I do with my channel is I screen share. and that's all I do. And I pretty much do it in one take because I have no time really to dedicate to the channel and to improve it. And I kind of feel bad about that. I wish I could kind of offer a better experience for my viewers. So hopefully in time that'll be coming up. So really all I'm concentrating on is really just the material of what it is and not so much the production. And hopefully I can add to that. So that pretty much sums up what I'll have going on in the future.
Wow. Joe, Kevin, it has been an absolute pleasure, a privilege, and an honor to actually host this series. I know I have certainly learned a lot in every episode that you guys have come on. I've read through every comment, and a lot of insights were dished out by the both of you, where a lot of my viewership got a lot out of it. And I certainly hope if you haven't by this point, go over to Joe's channel and Kevin's channel, continue to track them, keep up to date with what they're doing, and of course, all the dividend insights that they are divvying out every single week. To the both of you, thank you so much again for joining me on Masters of the Market. And investors, as you know, until next time, we will see you all there.